The industry summarized the rule list as a maximum 30-year term as the core of the QM feature set. So to roll out, excuse me, to roll out 50-year mortgages at scale through government sponsored enterprises, regulators now have to get involved, and they have to decide whether to adjust the QM framework or simply position 50-year loans as non-QM or otherwise specialized projects. That decision is certainly going to affect the investor's appetite. It's going to change capital requirements, as well as how lenders have to document suitability and explain this trade off for customers. Again, it has to make risk sense to a lender that if you're a first time home buyer at 20 years old and you bought a house, you can't pay off this house until you're past retirement age of 70 plus years old. If you are the average home buyer in the United States and you buy a home in your 30s, tack on 50 years, you are well into your 80s before you could possibly pay off your first home. Now, let's be realistic. We know good and well 80% of the people that buy a home do not pay it off. They simply refinance it or sell it and buy something else, blah blah blah. It is the consistent cycle keeping people in the mortgage game. This may force people to stay in their original purchased home longer, which could also cripple the current market. One of the things that we're having struggles with now is a large percentage of homeowners in this market had a low interest rate when they bought their home, so selling it in a 6% rate doesn't make any sense to them, and they're losing all of that potential P&I payment leverage. And then buying something else at 6%, they're having to buy something much, much smaller and at a much lower cost so that they could instead of the old theory of take your home, invest in the payments for 7 to 8 years, sell that home, take that equity, move it into your next home. That is a more generous down payment, putting you in a stronger position to move forward. Now it would potentially be the opposite. In this market, you're taking a 2 to 3% interest rate. You have a nice big house. You're having to take now for the same, let's say, $400,000 mortgage to get that same $400,000 mortgage at an interest and at a payment that you can still afford. You're having to buy a much lower property. So you'll probably have to buy at a $300,000 marker or lower, depending on the market taxes, to have that same total cost of ownership. So, still a lot to be determined as to whether this might move some things along in the housing market, but whether or not it would help the people that are having the problems of being priced out of the market today remains to be seen. To roll out these 50-year mortgages at a scale through those enterprises, trust me, the lenders have got to understand not only a strong sales pitch, but must understand what the trade off and risk is to the customers. And ultimately, they're going to have to redesign all of their qualification sheets to make sure people can actually do it without reapproaching the ageism problem of, hey, I don't know if you look like you're in good enough health to have a 50-year mortgage. That will never be allowed. God forbid we actually add health and condition of health as a protected status in the United States. Wouldn't that be a killer? Let's talk about some of the potential benefits and weigh out the key risks to this. So, some supporters inside the administration are arguing that a 50-year option could certainly help payment constrained borrowers, especially the younger borrowers in a high cost market. Qualifying for a home has been more and more difficult. Proven numbers, can't argue with facts. For clients who maintain the obstacle in the monthly payment arena rather than a term problem, a longer term could make the difference between remaining renters and actually entering the buyer's market, particularly if they expect to move or refinance within a decade. Now, housing economists and industry groups have been a lot more cautious. Experts are quoting Politico. They're warning that ultra long mortgages could lead to households with thinner equity cushions. So, longer increase of vulnerability if prices flatten or, God forbid, fall. They're also noting that more buyers could carry mortgage debt into their 60s and their 70s, and that lengthening that term does not resolve the underlying supply shortage that's driving these higher prices. So these are all things that you have to consider. Real estate pros, listen up. For now, the 50-year mortgage is simply a proposal. They are looking for ideas to help fix the structure. Personally, I could absolutely see a 50-year lien on a business versus versus traditional real estate. But that all remains to be seen how a product like this would actually work for anyone. This is not a product that you can just put on a rate sheet, and you certainly can't discuss it with your clients now like it's a reality. It is as far from a reality as getting back to the 3% interest rates. But clients are already hearing about it, and they're looking for you for context. So, again, a few practical talking points for you so that you know what you're doing. And yes, listen up. Here's where it gets spicy. Stop talking out of both sides of your face. You have an obligation to your clients to be honest and to have integrity in helping them make their decisions. They are not the expert, you are. This is not a transactional sales organization. This is a this is an industry where people need leadership on how they can move forward without crushing their family's hopes and dreams on the largest investment they are ever going to make in their lives. And you have a responsibility of keeping it honest. So pay attention to what I'm about to tell you. Oh, let me back up just a second. First, I need you to emphasize that a 50-year mortgage, if it emerges, will lower monthly payments by extending the term, but at the higher cost of a lifetime interest and a slower equity build. Ultimately, if you're paying off the same house in 50 years versus 30 years, logically, it's going to take you 20 more years to pay it off. So that line to pay off is much slower because you're stretching it across a 50-year term. Emphasize that risk to your clients. Second, comparing it with existing tools, such as the affordable rate mortgage. Those have caps, permanent or temporary rate buydowns, programs like FHA and VA and USDA loans. These may address similar affordability issues with, hopefully, better trade offs. Finally, encourage your buyers to think about the likelihood and the holding period, career trajectory, retirement goals before they take out a long term debt like this. As the FHFA, the CFPB, and the GSEs all decide whether or not to move forward with an option like this, the key question in the industry is going to be, where does a 50-year loan fit within the QM framework? How are they pricing it? How are they underwriting it? And whether or not it will remain a niche tool for specific borrowers or whether it will evolve into a broader part of the mortgage landscape. For those of you that don't listen to the show very often, I am Alexander Bartneski. I am the what will be the lifetime broker of Keystone Property Consulting Firm. We are a consulting firm first that leverages real estate knowledge and real estate capability with real estate agents and with brokers to make sure that the largest investment strategy in the United States, the housing market, can be leveraged with truth and with integrity. If you need advice, if you need understanding as to what you should be doing less, there's zero obligation to do business with us after an initial consultation. So please give us a call, get on our books. We'll set an appointment with you. We're happy to discuss your concerns or your future goals so that we can set a roadmap to getting you into the housing market when you're ready.